Okay, what is up, tycoons? What's up, traders? Today's video, we are going to, basically speak on the Federal Reserve. We're going to go over their balance sheet as well and take a look at how the Fed balance sheet compared to the stock market is really a crucial indicator and, something very important that I'm paying a lot of attention to right now. We'll dive into it further a little bit more. All right. Basically, we're going to cover how the Federal Reserve has raised its policy rate of interest this past week. But investors now think that this will be the last raise for a while. The Fed continues to oversee the shrinkage of its securities portfolio, keeping up a steady decline over time. The Fed did oversee a rise in bank liquidity this past week, maybe in continued response to the trauma still present in the commercial banking system. And how long will the Federal Reserve keep this up? We really don't know. So make sure to smash that like button and subscribe to the channel if you guys are new. As always, this video is not financial advice. This is for informational and educational purposes only. Trading in stocks, bonds, commodities, and crypto involve a significant risk of loss. So be sure to read through the full disclaimer before moving forward. And what the Federal Reserve did was what everyone was expecting them to do. They raised their policy rate by 25 basis points, and now the policy range runs between 5% and 5.25%. This was the 10th increase in the policy rate since the Fed began to raise the rate last March. There's a feeling that the Fed will back off from raising the policy rate again in the near future. The next meeting of the FOMC committee or FOMC is set for June 13th and 14th. In the statement the Federal Reserve released following the FOMC meeting and in talk after the meeting, two things were stressed. First, the Federal Reserve stressed how important it was for it to achieve its goal of bringing the rate of inflation down to 2.0%. Second, the Fed emphasized that they would continue to watch the data coming in to determine what further Fed actions would be needed in the future. Many interpreted this second part of the message as a signal that the Fed would not move the policy rate any further in June. Now, something significant that the Fed's done is they've really stepped away from forecasting what they're going to do now. And now they're kind of just, rather than giving any hints, they're just saying, hey, we're going to be data dependent, right? Whereas before, it was kind of expected and they were giving hints that they were going to continue raising interest rates. And raising those rates, now there's not as much clarity, and there's a lot of speculation, whether they're going to pivot, whether they're going to pause, or, when, the Fed will actually start to cut rates. If we dive a little bit further, all right, we can see the response by the market. The stock market declined initially, right? It dropped about 29 points on Wednesday and then followed this up with a 30-point decline on Thursday. We saw a very strong rebound on Friday, however. Now, furthermore, on Wednesday, the price of gold rose about $18 per ounce, closing at $2,044 per ounce. On Thursday, the price of gold closed at $2,058 per ounce. This is quite near the historic high for the price of gold. These were not exactly the results that the Federal Reserve officials were expecting from their move. Many investors still feel that the Federal Reserve leadership is going to pivot soon and get off their stance of monetary tightening. Now, monetary tightening are things like quantitative tightening, right? The Federal Reserve still continues to oversee the decline in its securities portfolio. The securities held outright at the Federal Reserve declined by $43.1 billion in the banking week ending May 3rd of 2023. These data is taken from the Federal Reserve statistical release, factors affecting reserve balances of depository institutions. Now, the complete decline came in the Fed's holding of U.S. Treasury securities. Now the decline in the securities portfolio looks like this. And so we can see here, we have that sharp decline right here, okay? And, essentially that's what we're covering right now. And to me, this is why we're seeing so much volatility in things like TLT and the bond market, okay? We have to realize that not only is the Fed, essentially rolling off their balance sheet, right? And they're not necessarily buying treasuries anymore. But you're seeing these large bank liquidations and, these bank collapses where they're being forced to sell large amounts of treasury to raise cash. And oftentimes that's not even enough necessarily to save the company. So when you have tons of money, needing to be sold and needing to, raise that cash and get it liquid, they're going to be dumping these treasury positions, and this is going to cause huge volatility in the treasury market. Now, overall, since the middle of March 2022, the securities held outright by the Federal Reserve have dropped by just over $740 billion. That's a very large amount. In this part of the monetary tightening program begun by the Fed, the central bank has done a pretty good job. And like the other quantitative programs it has engaged in, the change in the securities portfolio has been very steady. Now, with respect to the excess reserves that exist within the banking system, this past banking week, we saw a rise in banking liquidity. Reserve balances with Federal Reserve banks rose by just over 34 billion. Reserve balances with Federal Reserve banks after falling fairly regularly since March 16th of 2022, they rose dramatically in the early part of March 2023 as the banking system experienced two failures, right? And that's what we see right over here is we see that big spike, okay? And that was simply because of the banking failures that we saw. As reported last week, the Fed has seen these excess reserves move off the Fed balance sheet as the banking system seemed to stabilize. However, on Monday morning, it was announced that JP Morgan and Chase was taking over First Republic Bank, and the reserve balance with Federal Reserve banks rose, apparently to help with the acquisition. Right. And so that's what we're seeing over here is it started to rise back up. So initially we saw an increase, okay, because of the bank collapses, right, around Silicon Valley Bank and others. And since then, it started to decline, but we actually saw another rise again as the Federal Reserve was helping with the acquisition of First Republic Bank by JP Morgan. Now, it looks as if the Federal Reserve is staying right on track in its fight against inflation. Of course, everyone is waiting to see what happens next. Mr. Powell, the Federal Reserve Chairman, continues to present a picture of the Fed staying on course to get the rate of inflation down to the Fed's target of 2.0%. Although the rate of inflation in the United States has continued to decline, the year-over-year rate of inflation of the Fed's target index remains around 4.5%. So there still is a ways to go. And as mentioned above, it seems as if many market participants have their doubts whether or not Mr. Powell will stay the course. Now, this comes up with that popular phrase of fight the Fed and don't fight the Fed. Essentially what people are doing right now is they're fighting the Fed, right? They're pricing in and starting to speculate that the Fed is going to cut interest rates and pivot sometime soon, rather than just going by what he is telling you guys that he's going to be more data dependent. He's not necessarily about to pause or pivot. He's not really giving any clear indication. He kind of answers the question yes on one question and leans towards like, hey, yeah, we could be pausing, and then the very next question he kind of goes totally against that and says some things that indicate he doesn't really see any reason to pause at all. Now, in the foreign exchange market, the value of the US dollar continues to remain weak. As I've reported regularly in recent months, it appears lots and lots of money is flowing out of the US dollar, and talk of de-dollarization continues to stay around. This is not good, but this is what Mr. Powell and the Federal Reserve have to deal with right now. I particularly suggest that interested investors keep a close eye on what the Fed continues to do with its securities portfolio. Any break in the quantitative tightening will be a real reason to think that maybe Mr. Powell and the Fed are really pivoting from the tight money posture, and this would be major. So what I've actually got here on this chart for you guys is the Federal Reserve balance sheet, okay? And as we see, if the Federal Reserve balance sheet is going up, the stock market is also going up as well, right? And if we take a look specifically right over here, okay, we can see that this is, when they started pumping money, adding money back to the Fed balance sheet, whenever, the bank collapses started to happen. And what do we see? We saw the stock market has actually risen since that point in time. Now, we'll go into the next slide here in a little bit, and we can see that oftentimes there's divergences where these two are doing opposite things, and that's something you want to be a little bit cautious of, right? Or at least prepared for. Now, overall, the Fed balance sheet tends to hit a bottom and start going up again before the stock market does, right? If we see here, we see this decline in the Fed balance sheet, and then eventually the stock market bottomed here and started to rise as we saw a rise. It's very hard to tell right here just because of the scale of this chart, but the Fed balance sheet bottomed here, and then shortly after the stock market bottomed and started to rise again as well. All right, and so right now, we're really just trying to figure out where the Fed balance sheet is going to catch a bottom at, right? Is this thing going to continue to decline? Or, if Powell changes stances basically, and we start to see this go up, that could potentially mean that stocks are really going to continue going in an upwards direction as well. Essentially, this is one of the best indicators really to look, on a more macro perspective of, where's the market going to go? What's going to happen with the market? If the Fed is adding to their balance sheet and we see the balance sheet increasing, then, most of the time the market is going to start going in a bullish cycle, right? So, combine all of that stuff together, we have Janet Yellen, and we have the debt ceiling debate right now, right? And we have that crisis going on. And, in my opinion, I think that they're going to put up a fight, and it's going to, they're going to do what they do on the politics side of things, but I think that eventually the debt ceiling actually is going to be raised. We should see more on that in the summer. So pay close attention to that as well. All right, if we look at this next chart, what we see is the S&P 500 in red. All right, so the S&P is going to be in red here. And then we have on the top chart, we have liabilities and capital, all right, on the reserve balances with the Federal Reserve banks. And then over here, we have the S&P again in red with the total assets, less eliminations from consolidation. And so what I want to show you guys, I mentioned before, is the divergences, right? So take a look here when we see the S&P 500 going up, but we see, this going down right here, right? Eventually, what that led to was a big correction in the stock market, okay? And over here, we can see, really specifically at this point when this started to shoot up, the stock market has gone up since then. But, afterwards, it's continued to decline, but the stock market is still continuing to go up. So we have a divergence there. We really need to be cautious of, okay? I'm not saying you need to panic sell everything, but we really need to be cautious because if that continues to go down, we could see a drop in the S&P 500, similar to what we had before when, we saw these divergences, right? And we can see it a little bit clearer over here as well. Right, we're seeing this go down, and we're seeing the S&P 500 continue to go up. And this divergence is something that you want to be cautious of, guys. Right? If you take a look here, when we had the stock market going up, and then we had this going down, we ended up seeing a correction to the downside shortly afterwards. Okay, so that's something that you want to be a little bit cautious of, a little bit prepared of, is that essentially, if this is still going down and they're still doing this quantitative tightening and not really adding, okay, then there is a chance that the stock market would be due for a correction from that.